JBlog, June 7th, 2009. Today I'd like to start out by looking at the US dollar index, which is the US dollar measured against 6 other currencies. And I'd like to point out that the US dollar, short term in the last 6 months, made a high back in the first week of March as compared to these other 6 currencies. And from there on dropped quite steadily down to a low point right here. Now when you track that against the New York Stock Exchange, you find that in the same week as the US dollar made its high, the stock market, the New York Stock Exchange Composite, made its low and then started going up from there. Now what we see now is we see what looks like to be a reversal of the US dollar once again going up. And that could very well mean that what I've been talking about for a while, about this first leg up in either a bull or bear market, it's not quite clear what yet, might be coming to an end very soon. That's why I was looking at the market. I believe the market to be quite oversold at this point, and why I started taking defensive short positions to hedge against my long positions that I'm also holding. And I continue to sell out of my long positions and start taking on more and more short positions. Oil seems to have starting to hit a ceiling somewhere around 70, which kind of makes sense. One of the reasons why oil started going up substantially is that future contracts were actually substantially higher than, or far future contracts were much higher in price than close contracts. So what traders did is they basically bought oil today, stored it in tankers offshore, and then sold future contracts against it for delivery 3, 4, 5, 6 months down the road. Now, obviously, this is a very good way of making a lot of money very quickly. Unfortunately, it ends when the future contracts start no longer being high enough for the present contracts to pay for the tanker rental costs. Here's the NYMEX, exchange showing the July futures for oil being $68 roughly, and the December being 72. Now in the beginning of the year, actually in March, that was about $5 difference between the two. 5, 6. It was quite substantial. I imagine tanker rates are going up as well. In any case, the point being that eventually this relationship will reverse and future rates will come closer to present rates, and it could very well be that we have now reached that point. So one of my trades has been to short oil by using the DTO, which is the inverse oil ETF. It's a double, so it moves quite quickly, and this is basically what it's been doing. It was trading all the way at 250 and has dropped, and that was beginning of end of February, beginning of March, and has dropped to 76. I got in here at 80, and I've been holding this position since, simply because I believe that oil is starting to get too expensive, and I'm willing to short it a little bit here and take a larger position of the short as prices drop. That's one of my trades. Another trade that has not worked out so well so far is that short Goldman Sachs, as well as short the financials in general. Goldman Sachs has definitely increased. I still continue to hold this. I have a very small position in it. Not so much that I feel that Goldman Sachs is a bad company, but if the financials drop, then Goldman Sachs will drop along with it, and it makes a lot more sense to me to short a company that whose stock trades at $150 and one that trades at $5 or $11. The risks of an $11 company going to 20 are much higher than a $150 stock going to 300. There's just a psychological barrier there. The other one that I have is SKF, which is an inverse against the financials. It's an inverse to XLF. So XLF, the financials has been going up, up, up. But it has not exceeded this high set in the beginning of May, and it's basically been trading sideways. Eventually, this should fall down along with the stock market once the stock market reverses. So those have been my two short trades as well. I have been taking some I've been selling some covered calls against some of my long positions, like for example Agrium. I sold the $50 June, which will expire in a couple of weeks, third weekend in June, and I'll be collecting premium. I believe that it's a good company, good market to be in, but I'm okay if I get exercised at 50, and I'm also okay to just keep the premium. Either way, I'm making money. I like that. And I've sold some other offsetting option positions against some of the holdings that I have, like STLD. So that's once again my expectation is there to be a reversal. I'm looking mainly at currencies at this point, as I said. The US dollar is starting to worry me. I mean, it's starting to worry me that it has been dropping too low as compared to some of the other currencies. For example, if we start looking at the Australian dollar right here, it is starting to show some weakness. This is a commodity currency. It's driven by the price of commodities. It has had some two quite strong up days after being overbought. The Canadian dollar, no, British pound first, again partially driven by commodities and the fact that the British economy really isn't doing that well. Um, the Canadian dollar, driven by oil, again is starting to show some weakness here. It was probably overbought. It wants to come down, and it will be coming down. The big one is the euro, of course, having suffered a major negative day on Friday. Again, it shows some weakness, and when people have to escape out of these other currencies, there's only one thing to buy, which is the US dollar. And if people are generally herding into the US dollar, then all other asset groups will generally drop. So that's my trade, continues to be my trade. It's taken a lot longer than I thought it would, but I'm still quite nervous. It's quite high. I don't feel like being long here. I'd much rather be short and just sitting and waiting, because sooner or later this market will come down. That's my take on the market. Have a good week and happy trading.